Got a good credit score? If so, you might be paying more for a mortgage starting on May 1st. Here's what you need to know about the new mortgage changes, how badly high credit score borrowers are really getting shafted, and how mad you really need to be about what's going on.
I'm in a glass case of emotion!
By now, you've probably seen the headlines that borrowers with good credit scores will be paying more for their mortgages, and those with lower credit scores will be paying less. And it is true, there are some big changes coming to mortgages starting on May 1st, 2023. There's been plenty of outrage from the typical sources about how the people who are responsible with their money are subsidizing the people who aren't, socialism, freeloaders, yada yada yada.
It's a direct attempt to inject socialism into the economy.
Some people have even gone so far as to say you're better off tanking your credit score before applying for a mortgage with these new rules.
So I guess we have to teach borrowers to worsen their credit before they apply for a mortgage in order to get the better price.
To me, that sounds a lot like the people who tell you they're not going to accept a new high-paying job offer because it'll put them in a higher tax bracket. But I wanted to be sure, because buying a house is one of the biggest financial decisions most of us will ever make. People struggle for years just to save up enough for a down payment. And getting a mortgage and going through that house buying process is also one of the most complex financial transactions that most of us will also ever engage in. So I dug beyond the headlines, through the BS, and actually read all the documents. And here's what you need to know. If you think home buying is out of reach for a lot of people today, in the early 20th century, homeownership was next to impossible for anyone who couldn't pay for their entire house in cash, which wasn't any easier to do back then than it is today. Fewer than 50% of the US population owned a home in 1930, and homeownership fell to a low of around 43% by the end of the Great Depression. Then, enter Fannie Mae, who shockingly is not an adorable old grandma used as a spokesperson to sell you a bunch of delicious cakes and pies and desserts, but rather something created by Congress coming out of the Great Depression to provide steady, reliable funding for home buying. And most importantly, the creation of Fannie Mae brought along with it the now super popular 30-year fixed interest rate loan. And from the introduction of Fannie Mae after the Great Depression up until around 1970, the percent of home ownership rose from that 43% up to around 64%. Then in the 1970s, Freddie Mac was created with many of the same goals as Fannie Mae in mind. And from there, we saw home ownership in the US peak at around 70% in the early 2000s. Currently, it sits somewhere around 66%. Now, obviously, there were a number of other factors to the rise in the percentage of ownership over that time. But the point is, the effect of Fannie Mae and Freddie Mac really can't be understated either. They're still huge players in the mortgage markets today. In 2019, 42% of all mortgages initiated in the US were backed by either Fannie Mae or Freddie Mac. And that number rose up to around 60% during the pandemic years. And I bring all this up because it's those mortgages backed by Fannie Mae and Freddie Mac that these new rule changes apply to. So you can see, a lot of people are going to be impacted by these rule changes. And the headline that's been going around that you've probably all seen is that borrowers with a 740 credit score will pay 1% in fees, and people with a 620 credit score and below will get a discount of 1.75%.
Socialism.
But as per usual, there's more to the story than the headline will tell you. And the first thing I gotta point out is that all these percentages we're talking about here are not on the interest rate of the actual loan. They're on something called the Loan Level Price Adjustment, or LLPA, which again isn't something totally new. During the mortgage crisis of 2008, Fannie Mae and Freddie Mac, like most other firms in the industry, were undercapitalized and overexposed to risk. And again, like everyone else in the industry, Fannie and Freddie were losing money fast. So they decided to increase fees on new mortgages. Some loans are less risky than others, right? And realizing that, loan level pricing adjustments, or LLPAs, were created. And an LLPA is exactly what it sounds like. It's an adjustment to the price of your loan. Now, there are several risk factors which trigger a loan level pricing adjustment, like how much money you're putting down, the type of property you're buying, and a few other things. Credit score is one of those other things that determine your LLPA fees. And it's this part of the LLPA fees that are now changing, triggering all the housing socialism, and mortgages for people who can't afford them, what could go wrong takes that you're hearing out there. And I'll just get this out of the way now. that is in no way what's actually happening here. This isn't the first time that LLPA rates or qualifications have changed, and these current changes were actually announced all the way back in January, but you're only hearing about them now because they go into effect on May 1st, and we just don't care about anything until the deadline arrives. So up until now, the LLPA fees by credit score look something like this. If you have a credit score of 740 and put a 20% down payment on your mortgage, you'd pay 0.5% LLPA fee. If you had a 620 credit score and also put down 20% on your mortgage, you'd pay a 3% LLPA. And you can see on that chart how the percentage changes by the credit score and how much of a down payment you're putting down on your loan. So that's the old structure. Now let's look at the new fee structure with the adjustments coming starting May 1st. So under these new rules, starting May 1st, that same person with a 740 credit score putting 20% down on their mortgage will now pay 0.875 LLPA, an increase of 0.375%. If you're that person with a 620 credit score putting 20% down on your loan, you'll now pay 2.75% in LLPA fees, a decrease of 0.25%. If you've got a credit score above 780 and you're putting down 25% or more on your mortgage, you'll actually pay 0%. You'll pay no LLPA fees at all, down from 0.25% under the old structure. Now, all the outrage and controversy over this stems from the fact that some of the fees increased on borrowers with credit scores of 680 and above who put less than 20% down, while lowered for borrowers with credit scores under that amount, also putting less than 20% down. So back to that screen cap you've probably seen all over social media lately. You can see how this graphic is misleading at best. What it's doing is comparing the actual fee that one credit score will pay if putting down a 15% down payment with the change in the fee a totally different credit score will see with a totally different down payment. If we were to do an apples to apples comparison with what they're showing on the screen there, first we'll compare the fees at a 15% down payment, which is where that 740 credit score paying a 1% fee comes from. Under that same scenario, a 620 credit score putting down 15% on their loan would pay 3.25% in LLPA fees. And if we look at the other half of that graphic, the 1.5% decrease in fees for a 620 credit score, that comes at a down payment of 5% or less on your loan. So putting down 5% or less, a 620 credit score would see a decrease of 1.75% to a rate of 1.75%, and a 740 credit score putting down that same 5% down payment would also see a decrease of 0.5% to 0.5%. So at that level, it's like the fees are getting cut in half for each credit score. And yes, the largest increase, the one grabbing all the headlines, is that a borrower with a 740 credit score putting down a 15% down payment will pay a 1% fee, up from 0.25% under the old rules, which on a $400,000 loan at a 6% interest rate will mean a $40 per month increase in their monthly payment.
Socialism.
But for a high credit borrower putting more than 20% down, well, your fees just went down too. For borrowers putting a 10% down payment down on their loan, someone with a 620 credit score will still pay an LLPA fee that is 10 times higher than a borrower with a 780 credit score. So it seems pretty clear that you don't want to go tanking your credit score before applying for a mortgage after May 1st. I'm going to go out on a ledge here and saying that making a few slight tweaks to a fee schedule doesn't represent the takeover of socialism or represent people with good credit scores subsidizing those with lower ones. Because under no scenario in these new rules will someone with a lower credit score be facing less in fees than someone with a higher credit score.
Socialism.